But I'm going to go ahead and hand this off to Imran Alibhai, who is the Managing Director of D-Matrix, and he's going to talk about marketing competitive analysis.
Great. All right. So, as way of background, my name is Imran Alibhai. As Will mentioned, I am the Managing Director for D-Matrix. First of all, this should be interactive the whole time. I mean, you shouldn't interrupt me when I'm introducing myself, but after that, free to ask me any question you'd like. I thought maybe you should hear a little bit about who I am, and then why and how I got to where I am, and then we can just jump into this. As way of background, I'm a Texas boy, actually raised in Dallas. Went to Duke as an undergrad, came back, went to UT Southwestern originally as an PhD, ended up just doing the PhD portion. Went off to the West Coast to Seattle to a corporation called the Accelerator Corp. We were a venture fund that was backed by 5 of the largest VCs. And we invested in technologies like what you guys are thinking about. Literally technologies that came out of laboratories where we would act as a management team, and then we invest about $5 million. So 3 of the companies we invested in, we raised $5 and $6 million in, and then the people who backed us then said, if you meet these Series A milestones, we'll be there for the Series B. Those companies went on to raise $50 million, and all of that exited. So it was how to do early stage. And it was great for me because it was the perfect job. I had no idea what I was doing. I was you, for a lot of you. Some of you are older than me, but I just finished my PhD, and I had great interest in doing something besides being an academic. And it was a good blend of learning the business side of science. From there, I went to the largest VC in the US at that time. It was MPF Capital. They had $3 billion under management. I worked primarily in the hedge fund. So I covered oncology, med devices, diabetes, metabolism, all across the board for them. And so it was small to mid-cap public companies. The last time I took an econ class and I worked in the hedge fund was 10th grade. So if I can do this, you guys can do this, okay? Like, there's nothing that happens in the world of finance, if you wanted to go there, that you can't figure out really easily. Thereafter, I went to New York. I ran a private arm of a big public company. We had about $150 million venture arm that we invested out of, and we made the Series B type investment, so right after the original seed money we put in. And then most recently, before coming back to Texas, I was an investment banker. So I worked for a really famous investment banker who worked with Lehman Brothers for 40 years, and he went to a boutique, and I was his first hire. And so we did deals all across the board. A couple of the ones I worked on were, we sold Euronext to Quarter for $133 million. That was for a nasally delivered diazepam. We sold GE a dead and water feed system for access to $100 million. So we did some cool deals. We sold CV Therapeutics, Gilead, for like $3 billion. So it was cool. We ran around. I got to meet some great people, and I had a lot of fun. Came back to Texas because my wife was from Texas, and for those of you who aren't married, or those of you who are married, happy life. She got pregnant. She's like, "Where are you moving?" I said, "Where? Connecticut, New Jersey?" She's like, "No, Texas." So came back here, and I had a couple brief stints working for the BioAlliance at the Texas Medical Center, basically being a consultant to interesting technologies and helping things get off the ground. One of the things I did was help raise $30 million for this company, D-Matrix. D-Matrix is a series. We raised $20 million in Series B money and $11 million in secret, and we are starting phase 2 trials in glioblastoma. So our technology is pretty cool in the fact that when you have a recurrence of glioblastoma, you have an average lifespan of 4 months. In our original phase 1 trial at MD Anderson, 52% of our patients responded to our therapy, and those 52% of the patients lived 15 months. So a tremendous improvement in overall life. There's not been one drug that's been approved in the last 30 years in this designation that's increased overall survival. We have still 20% of our patients live over 2 years. So that's what kind of brought me here. And the reason they brought me on is like, look, there's so much to do as a startup. You guys know this. There's a tremendous amount of work to be done. And so they were saying, well, we know you can do this. And eventually we'll sell this company. Like all the companies you guys generate, none of them will ever become Johnson & Johnson. None of them will become Medtronic. They will all get acquired. Or they go public and then eventually get acquired. So, which could be a very long process. But you're building these companies to be successful, and with success comes acquisition. You don't build the companies to be acquired. You build them to be successful. Okay, there's a distinction there. When somebody comes to you and says, I'm going to get acquired at this point, they never get acquired. But when they say, I'm going to be successful, and this is how I intend to do it, somebody comes in earlier and buys it because they see the plan for success. So this is marketing competitive analysis, one section of stuff that we do. And so my first question to you guys is, why do this? Why do market competitive analysis? Why go through all this work? Look at your stakeholder analysis, the competitive analysis, segment your market. Why?
If someone else has a really great solution to the problem, they're probably it's very hard for you to educate them to cover any market share.
That's perfect. It's whether or not I want to pursue this in the first place. I have this cool technology. Does anybody else care? Right? Is there somebody already in front of me? There's one other reason I came up with. There might be other reasons. Anybody else? Come on, this is not hard. Because your investors care. Your investors don't know this. They don't know who your patient population is. They don't know who your competitors are, and they certainly haven't gone through work and segmented. So if you want to raise money, you better know this down pat. You better know everything there is to know about your drug and where you intend this drug to go. Okay, and the other thing I want to tell you is that I apologize. My whole life did biopharma and medical devices, mostly biopharma. So maybe 75% of what I've done is biopharma, 20% is med device, and 5% healthcare IT. So a lot of my tilt is towards the biopharma and whatever, but I can speak intelligently about it, just to be enough dangerous. And I'll tell you something, I know nothing, I know a lot about nothing. I know a little about everything, which is good if you want to be an investment banker, but really bad if you want to be an entrepreneur. So when you're an entrepreneur, you got to know everything about your product, and that's what I'm actually transitioning, doing what I'm doing. So as I mentioned, there's 3 different things you have to think about, and now there's a lot of other things, and hopefully the Inventors Foundation's talks will give you some of that benefit, but I've been tasked to talk about these 3 things. So let's first think about the stakeholder analysis. So when you think of a stakeholder analysis, you think of, well, I've got this medical drug, device, whatever you want to call it, and you're like, this is the coolest thing since sliced bread. It really is. This is going to make life awesome for patients, right? And you think, that's my stakeholder. That's not who I'm building it for, right? But the real reality of it is, this is stakeholder analysis. It is never the patient, unfortunately. Sometimes you think it is, but it isn't, okay? You can think about, like, for example, you guys might have heard of this company called Pharmacet. It was acquired by Gilead for $11 billion. Okay, because they had an HCV drug, okay? And people have been trying to solve HCV for decades, right? And everybody was thinking, well, what do if this is a population of patients that's interesting, and HCV can lead to cirrhosis, and then cirrhosis can cause liver transplants, it's a whole problem, it can also lead to cancer, so this is a big problem. And so that's why we should make drugs for it. But nobody was interested in investing in it until they thought, well, can we really solve the problem? Because with too many viral drugs, all you do is delay the problem, right? You don't cure the problem. Until they found a cure, which, I don't know if I have a marker or whatever. Until the payers and the shareholders got involved, that it becomes something really, really exciting. And a bunch of companies were sold at the same time because everybody saw promise in these phase 2 drugs, which could cure HCV. And the biggest launch of all time was a drug called Sovaldi by Gilead, which was purchased from Pharmacet for $11 billion. In their first year, they sold $25 billion of this drug. They charge $120,000 for it. But they're like, look, after 12 weeks, you're cured. You'll never have HCV again, right? You find something like that for HIV, you'll get the same thing and even bigger. But HCV, and we were out as bankers pitching all the HCV companies because we were like, we want to cash in because bankers get paid when they sell a company, otherwise they don't get paid ever. And we were trying to get into this market. We represented a couple companies and we were trying to get into it. But it wasn't interesting because even if you made patient life interesting and longer, nobody cared. It wasn't until the payers got involved and they would reimburse you for it. So in the other thing that's also very important, particularly in med device, okay, it's also true in drugs, is that sometimes what the patient needs is not what the physician cares about, or it's not what the hospital cares about. And so if those come in direct conflict, the patient loses every time. Right? Because if the payer's not going to pay for it, it's never going to make it to market. If it's not going to get reimbursed, you'll never get it there. If it doesn't fit with the hospital and the hospital's other contracts, they'll never get there. Right? You make the next best catheter, all right, for aortic aneurysms. But J&J is already in the market for aortic aneurysms and catheters, and they have a group purchasing order with the hospital. Right? And they say, if you go buy theirs, you lose our contract. So you get a discount of 25% for all of your med devices that come from J&J. You go buy this person's, see ya. Who do you think they're going to pick every time? Right? So that's something you have to think about. And it's incredibly important because they do come into direct conflict. It's not something you can take lightly. So we'll run through these quickly. You'll see these are very textbook things that you're going to learn now, right? And we'll try to do a little case study, and we're going to talk about insulin, inhalable insulin delivered orally, okay? And the reason it's important to me is because I followed a company called Vector at one time, which generated this drug, and we were long on this company. We were investors in the company. And I'm also a type 1 diabetic, so it was interesting to me. And and diabetes is a huge problem. I can guarantee you, everybody in this room has a family member who's diabetic. Okay? And I want you to think about that in the background of why we're talking about it, because there's a company right now called Mankind, and they've put out a new inhalable insulin. And they think they're going to market. They've formed a partnership and they want to go down with it. This is what we're going to think about at the end of the talk. So for the patient, the most important things are, hey, is this secure? You know, is this going to improve my quality of life? What is it going to cost me? And then out-of-pocket cost is more sometimes with an IT solution, honestly, rather than a drug, because drugs are covered, you know, for the most part. If they're going to be reimbursed, they'll get the market. It's very unlikely that you're going to get a drug that's going to be uncovered unless it's an aesthetic and not being covered, and then you pay for it out of pocket. And then ease of use is an important factor. For the physician, the most important thing is not even patient outcomes is important to them. So I'll tell you what the first thing is, the change in workflow. If you bring a surgical device into the hospital and you say, okay, when you're doing this surgery, now you have to look over here, go grab this and do this, and normally they just look down and somebody hands it to them, they're like, go after yourself. Honest to goodness, they'll tell you that. They're like, we're not doing that. I'm not going to change standard of care for your little device. Now, maybe if J&J is selling it to me and they're telling me, they've taught me, and there's put a bunch of marketing, but if it's you trying to get in, that's a really big problem. So when you're thinking about the physician, you have to think, how do I make the physician's life easier? Okay? And one of the things that with inhalable insulin that was the initial problem for physicians was they had to teach the patient how to use the device. Now, doctors get paid, and they can spend 10 minutes with a patient. They can't spend 30 minutes with a patient. So the nurses had to teach them. And then the nurses were like, we're not interested in teaching them. We need to go hire other people. And there was all these other complicated factors about it. We'll talk about it in the end. But nevertheless, you can take them out of them, even whether it's a drug or it's a medical device, particularly a medical device. The hospital cares about all of these things. And you read, and Sarantis can tell you about this, which company over there, that, you know, if you don't meet certain standards, Medicare will cut your funding. right? So if those standards aren't met, and whatever for either readmission rates, like the stay or whatever the total cost, it's important to them. Another thing that's very important in the hospital is you make a cool device. Let's say it's a really big device. Let's say it's like something that costs $50,000, right? It's a medical device. Well, once a month, once a year, or once biannually, they have big purchasing orders where they can make that decision, right? So you can't just infiltrate into the hospital and start saying like, look at this device, it's great, go buy it. They're like, well, wait 6 months when we have our next thing. And in the meantime, you're like, well, I told my investors that I'm going to be in this hospital and 3 others, and now I have to wait 6 months. And so it's something you have to keep in mind about how hospitals purchase things. And then, as I mentioned earlier with the catheter thing, if it's in direct competition with other catheters and something else is not interested in giving up their orders, it's not going to happen. Okay? The payer is obvious. Look, if it's not going to be reimbursed as a drug, it's not going to market unless it's an aesthetic. Okay? Unless you're making Botox or the next great breast implant or something for acne, honestly, no. And those are great markets. If you can find a solution for acne, it's a multi-billion-dollar thing. So go do it. But dermatology is great. But vast majority of what we think about, like cancer and such, it has to be reimbursed. And the problem is, let's say about 20 years ago, it was really great for biopharma and even med device. What they were doing is they'd say, I made this drug. And I'll give you an example. There was a drug called Cimetidine. It was a PPI, okay? It basically helped with reflux. And it was the first drug that came out. It was $1 billion. Literally, pharma went back and said, how do I work around these people's patents? And they made the next drug, which was, I think it was Tagamet or something. It was a $3 billion drug. But it literally was like a 1 bond change. And then Nexium came out, which was a $6 billion drug. This was the Me Too generation. You could put out drugs like crazy. That doesn't happen anymore. Now there's way too many generics, and the Me Too's, nobody cares about anymore. And the thing that also was, for a long time in oncology particularly, if you could extend life by a couple months, you were golden, right? Gemcitabine in pancreatic cancer. Extended life by 3 months, it got approved. If you extend things out by 3 months, nobody cares. You have to be wholly disruptive for people to think that things will go. And this is a question about the payers, and it's also a question about how reimbursement and how the FDA looks at you. Finally, this is the problem. These people are pains in the butt, okay? Because I was one of them. I was a jerk. They called me Dream Killer. Honest to goodness, that was my nickname, Dream Killer. Because people would come in and I'd be like, I don't know how to make money. My money costs me is expensive, right? I've got money from people and I've promised them returns. So you better give me bigger returns so I get a cut of my pie so I can return it back, right? A VC investor, they do 80-20. I don't know if you know what that means. That means on the first dollar that you invest in them, they have to return it back to their shareholders. And then every dollar above that, 80% goes back to their shareholders, and they keep 20%. So they need your stuff to be really worth a lot, because that's how they're going to get rich, right? It's not good enough for them you to return 1 or 2 extra times. They need it to be multiples, and they need it to be fast. So they have restrictions on their money and how it's spent. And so when you're early stage, like a lot of the ideas probably here will be, is you try to bootstrap and bring money from other places like friends and family or angels who don't have that kind of constriction where their cost of capital is not that high. And these guys are, they can also be disruptive in the fact that they're like, look, I want to sell this company now. And you're like, no, I don't want to sell this company. This happens all the time. And it's a problem. And so it's something you have to think about when you go to your investors or your shareholders, and you have to understand their needs. And if they don't meet your needs, you can't take their money, because they will ruin your project, because they have certain needs. And it doesn't matter. And And you could be a portfolio of a bunch of great things and then they don't care about you. But if you're their one great thing and everything else has failed, you're screwed. Because they need you to succeed and they'll be on you like light on ice. And we've done that. I've been part of that. I've watched it happen over and over. It happened in the private markets. It happened in the public markets. Okay? So this is what you see in the textbook. When you have sales over time. Let's say you get your product up to the market. Let's say it's a medical device, healthcare IT tool. And this is what the normal thing is. This actually comes from a book. Okay, this is what it looks like. Over time, you will increase sales because you will have a slow fold. Well, I think about 10 years ago, somebody came up with the hockey puck, a hockey stick. And this is what they actually teach. This is what they teach you. They're like, it looks like a hockey stick. It'll take you a lot longer to introduce your drug or your product, and it'll grow slowly. This doesn't look like it's growing. That's okay. But that's fine. And then at the end, it's going to do this. And I can't tell you how many people come to me with this, as an investor, and say, this is what I'm going to be. And I don't have a pointer, maybe I can figure it out. But, oh, great. Can you see this? No, I can't. Anyway, let's say time T, you're at time T, okay, where the T is on that schedule. And you're like, I'm going to be at the end of the arrow. So when you purchase me, you should pay me for this number, even though I'm at time T right now, I don't have anything. And they're like, but the promise of my drug is so great. The promise of my device is so great. And I'm like, that's not how it works in the real world, right? And actually, when you're building your curves, you'll never get to this number. It looks something like this. It's actually called an S curve. Johnson & Johnson came up with this. Lilly came up with this, sorry. When they were making the launch of Strattera, which is the ADHD drug. And they generated this S curve, which is basically, it's going to take you a lot longer to get to where you want. And then you're going to have a steep curve, but it's going to siphon off the top, because what you forget about is, as time progresses, other people will approach. And they will cause you to get cut off. Okay, so this is something people sometimes forget about. And why am I telling you all of this? Because you have to be, when you go to present to VCs or present to your investors, you know all of this, and you present it. I can't tell you how impressed we were as bankers when Euronext came to us. This was nasally delivered diazepam, which was referring to repetitive seizure. They came to us and they showed us it's going to be an S curve. And we're going to take not even 10% of the market. And so we think our market is $300 million. And they're like, we also know that pharma's not interested in $300 million. We want to be sold a specialty pharma. So they knew everything coming in the door. They made our lives a lot easier. But it was the people, as bankers or as investors, when they came in with the purple card, and they say, well, yeah, we don't have revenue yet, but you're going to get us paid off this other number. Right? When you can talk about the pink line and all the other things I told you about, and talk about it efficiently and effectively, that's when you get invested in. That's when you get sold. That's when people want to believe in you. Because what we lack here in Texas, unfortunately, is we've not been there and done that. We don't have a bunch of successful entrepreneurs. We have a few, but we don't have a bunch of people. And so you're walking in the door at a disadvantage, because investors invest in people. They don't invest in your ideas. They can give a rat's ass about your ideas, because they see thousands of ideas a year and they make an investment in 1% of them. Right? They want to make sure they invest in the people who can make sure that the good ideas get to the market. Because a great idea with a bad management team will fail every time. Every freaking time. It's the people who can pivot, because no matter what happens, there will be a change. Okay? So you can't predict what your budget's going to look like. You can't predict it. You just have to give your best sense. And then if you can convince your investors, you can pivot and make the changes when appropriate, you will. So that's kind of the stakeholder analysis. We'll talk about the competitive analysis and just give you a sense of how it works by industry, okay? These are all general swaths, so this may or may not apply to you, and really this is a discussion you need to have with people in your field. Okay, so I don't think this is God's word by no stretch. In biopharma, things that people care about by industry are safety, efficacy, and cost. You know why? Because safety and efficacy is what clinical trials are. Okay? Cost is important if you can actually get to market, but it's actually not even that important. It's safety and efficacy. Safety is your first few trials, efficacy at the end. In med tech, safety and efficacy is your clinical trials. Cost is if you're competing in a market. We'll talk about other markets and getting entrance markets. And then customer acquisition. Customer acquisition, who I'm talking about, getting into hospital at the right time, getting out to the GPOs, getting in front of the right people at the right time so that things can get employed. Healthcare IT is a whole different beast. Healthcare IT is, biopharma and medtech have gone away from the Me-Too's. They want disruption. Healthcare IT is a completely different beast. There's so much information right now out there. Hospitals and the epics and servers in the world have no idea how to manage that information. So if you come up with something that makes life a little bit easier, or can do that, then disruption in healthcare IT is not bad. You don't have to come up with the greatest thing ever. If you can do it, which the next talk, by the way, will be done by Decisio. If you can come up with a tool like they have in Decisio, which is basically, hey, we've combined all the things in a hospital room onto one screen, so doctors don't have to go around looking for stuff. That's what's cool in healthcare IT. Not, trying to come up with the most novel, amazing thing. It's just because there's too much information. And so they have to do it. So there's really a discussion of, hey, how does this cost, the business model, and customer acquisition. It's much more interesting there. So when you're thinking about your barriers to entry, these are pretty obvious things, so you should probably, I've already said most of them. You're thinking about very basic things, right? Like, so when it comes to a drug or a medical device, what does your IP look like? Is your IP better than everybody else's, right? There's a bunch of companies, you guys heard about CAR-T cells? It's like a real big deal right now, okay? They can solve hematological malignancies. And there's a bunch of companies like Novartis and Juno and a few others that have multiple billions of dollars of valuation because they've figured out that they can engineer T cells to attack cancer cells, particularly important or whatever. They all have the exact same IP. All of them have the exact same IP. Our friends at Bellicum are doing the same thing. They have IP too. And they're all like trying to figure out how to do this. When Juno raised their public round, in their filings, they set aside some ridiculous number of dollars. I think it was like $20 to $30 million for IP battles. Okay? That's how important IP can be, right? And for really interesting things. Also, your IP is important is if your mentor or whatever filed with IP for what you're working on 10 years ago and you want to move that forward, then you only have 10 years to get it to market, and then you have 0 years to sell it because your IP is 20 years, right? So you have to think about, whatever. I was looking at somebody's stuff the other day, and they were like, hey, this is going to be great, blah, 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 and I'm like, there's no IP pipeline. Literally you come to market and somebody else can sell it as a generic, assuming that so nobody's going to invest in it. The regulatory timeline is important for multiple reasons. The great thing right now, it's a great time to be a healthcare entrepreneur because the biotech market and somewhat of the med device and healthcare IT are exploding. People are investing earlier and earlier and earlier. Okay, there are companies out that are publicly traded. There's a company from Texas in Austin called Aglia. Okay. They're doing IND-enabling work, meaning they're still not in the clinic in human beings. And they're going public, or they're going to try to go public. Bellicum Pharmaceuticals, I'm not making up, they're doing phase 1, 2 trials. The first trials, and their market cap is worth $600 million. 5 years ago, when the market collapsed and there were no IPOs, there were just 6. When I was a banker, which sucked because if there's no IPOs, then when everybody's trying to buy the companies, they're like, well, you don't have any other options. You're not going to up the IPO market's growth, so you take what we give you, kind of thing, right? A Belgian company would be a $100 million company if they were lucky. But now the market is frothy. There were like 50 IPOs last year, okay? And half of them were for things before phase 2. So if the barrier isn't that high, to get to phase 2, to get to a phase 1 trial, on average, it's about 8 to 10 million bucks. That seems like a lot, but it really isn't in the grand scheme of things, okay? You can pull 8 to 10 million bucks from angel investors, honest to goodness, if you're really good, okay? Clinical strategy, kind of, we talked about this, physician's adoption, don't want to do other things. Supply chain purchasing, that's specific to IT, but really more of a device. You want to make sure that you're not competing with whoever they're doing and making sure you're being purchased at the right time. And then market penetration, which is what we talked about, right? How far are you going to penetrate? And is your niche device or drug or IT thing big enough to penetrate or interesting enough to get where you want to go, right? So here's a little interactive thing. Hopefully somebody will speak. Okay, I've got this inhalable insulin, right? I basically can give you insulin, you can inhale it. Currently, the way insulin is delivered is by injecting it, okay? And then there's people like me who are type 1 diabetics who big supporters of Medtronic and wear an insulin pump, right? But what else is against the inhalable insulin market? Okay, what else do diabetics take that could be filling in this chart? As you speak. Very nice. Wow, oral drugs. You're right. Oral drugs is one of the other solutions. Any other thoughts?
Patch.
Patch?
Wearable patch.
Those haven't really come to fruition, the wearable patches. There was at some time. The other thing is other injectables.
Implantable devices.
Implantable devices. Yeah. So implantable, then like organ transplants and implantable devices, the closed loop systems, right? So you know the etiology, not the physiology or the pathology of diabetes is this: you at whatever age you become diabetic, and it's because either you have autoimmune issues, like type 1s, or your body stops either producing enough insulin or doesn't take the insulin, it doesn't become insulin sensitive. And then you become pre-diabetic. As a pre-diabetic, you can be controlled by weight or food, but then you get to a certain stage and you need something to help sensitize insulin. So you take metformin. Okay, that's the first drug, first line. Every human being who's type 1 or type 2 diabetic gets metformin. Then they get TZDs and sulfonylureas. Then they go further down, and you've heard of these drugs like Januvia and all these other new drugs that everybody markets go crazy out of. Then those are your next ones. Then you get to other injectables, which aren't insulin, right? Because insulin is tricky. Insulin can cause you to become hypoglycemic. These other drugs, for the most part, you don't have a tremendous amount of hypoglycemic events. Hypoglycemia is basically when your blood sugar is so low that you can eventually trigger into seizures and death. And that's the number one SAE, serious adverse event, in trials when they're doing, when you use insulin. So that's what you're trying to prevent, okay? This is all important information for so I hope you're listening. But you're right, and so then you look at what you're doing, you say inhalable insulin. How does that compare to pumps or the orals, or how does it fit in the timeline too? Because it's very important, not only are you looking at efficacy, safety, and cost, those are important, but then you also have to think about where does it fit in the paradigm of treatment, right? That's an incredibly important thing, because you're going to have this continuum, and I want to describe it to you. It's food and diet, insulin, right? Where do drugs fit in? Where does injectables fit in? Where would inhalable insulin fit in? Why would anyone even use inhalable insulin? What's the purpose of using inhalable insulin versus anything else? Something to think about. I think this is the easiest thing in the world, and I don't know why, and maybe because I've been trained to do it, but this is so easy. Your competition is so easy to figure out. You just go to the FDA and see what everybody else is doing. You go to the other companies and you pull their reports. They have to give it to you if they're publicly traded. Their websites, their meetings, their conferences, they tell you what you're doing. I went to ASCO, which is the American Society of Clinical Oncology, the other day for glioblastoma. We didn't present a damn thing. We just went by all the posters, took pictures. Every poster took a picture. And we're like, and then we came back and we had this great presentation and came to our investors. And we're like, this is what's going on in glioblastoma. We still think we're better. This is why. Right? That's what people care about. Everybody else is doing your work for you. You can do this. If you're doing a medical device, you literally need to go up and pull up their FDA summary and see how they went through the clinic because they publish papers, right? And it tells you these are the trials done, this is how you do it. It's really not that hard. But you have to be trained to think about that. What you're doing is not novel. It's been done before. And if it's that novel that's not been done before, then you have a host of other issues that we'll talk about. The other thing that in particularly drugs and particularly devices, is that you can't be me too. I've already discussed this. You can't be me too. You've got to be disruptive. Okay? There's a company called Agios that's out there, and they have this great technology. They have a multi-$100 million market cap. They keep getting all these partnerships because they have an idea that we're going to go attack cancer from a completely different mechanism that people haven't used. So going after the old mechanisms of PI3 kinase or VEGF inhibitors, nobody cares about. You got to go find something that's completely different, completely new, and say it's completely disruptive or easy to do. Okay, and then all the stuff can. You remember, this is not a short time period thing. This investing is not for the meek of heart. It's going to take you 5 to 10 years to even think about sniffing revenue. So think about all those options when you're looking at who's around and why they're coming in. Okay, and then I think the last point is the important point. You know, in 5 to 10 years, there's going to be a bunch of other people out there. And that's why nobody gets the hockey stick. They all get the S curve because somebody else is going to come in, right? Gilead sold $25 billion this year. Next year, Abbott releases their drugs. And the year after that, Achillian releases their drugs. So, yeah, they took the market for the first year. They won't for a long time. Vertex had a drug for HCV. They sold almost $2 billion in the first year, which was a huge success. Gilead came along, that drug is now discontinued. In 2 years, it went from selling almost $2 billion to now being completely discontinued because the next best thing came. And I mentioned before when Vertex thought that they were in the driver's seat. They quickly pivoted. Now they're doing cystic fibrosis. They own the market. They're a $10 billion company. Okay? So that's what you've got to think about. This is important because we're going to do our little breakthrough. I'm going to be talking way too much and nobody's interrupting me, so we'll just go through this. This is important. This is the most important thing that you can do when you're thinking about your technology. One, to his point, it's because is my market big enough for anyone to care? And two, what is my exit opportunity? Because that's what the investor cares about, right? Who will purchase me? There's a great drug that's out there right now. It's for dyslexia. Nobody sells the dyslexia. 2.2 million kids a year have dyslexia. Nobody wants them in the market because nobody wants to sell any dyslexia. No one's ever sold into dyslexia, right? They just don't want to do the work. And farmers like, I'm out. We're not interested. So even though you've got this great market, if no one's ever sold into it and no one's willing to sell into it, nothing's going to happen. Unless you show this dyslexic medicine causes complete change of an outcome. And then how do you prove that outcome? Clinical trials. So, when you're defining your market, you have to think about a bunch of different things. And we've talked about all of these issues, right? Who are you targeting? Who is your customer? Is it really the patient? Half the time it isn't the patient. It's usually the payer, or it's the hospital, or it's the surgeon. It's rarely the patient, right? What is the gap? How do you fit into the gap? And then we'll talk about how to do a top-down and bottom-up analysis. So normally, this is what it looks like. This is what you see in books. You're like, I'm going to take that blue circle, that's me. Big circle. My cost is low, my efficacy is high, I'm awesome. This is what it looks like, really. Okay. There's an existing solution, there's one other one coming up, and they're going to all crowd you out. Okay? And so you think whatever number you're going to capture, it's never that number. Okay? Except if you're Gilead, it's 25 billion. Outside of that, it's probably not anyone else. We've never seen a launch like that. The blockbuster status was $1 billion. You got $1 billion, and everybody's popping champagne and going to the bank. 25 million is ridiculous. This opportunity here in the boom is where you're at, and it's going to get smaller as time progresses. So you have to make sure that that niche is so important and valuable, and that niche can expand into other things. So this is what I was talking about a little bit earlier about existing markets, resegmented markets, and new markets. Existing markets, that's what we've done all our lives, right? That's what everybody's done. It's like, hey, this is a drug, this is a device, it's been in the market, we know it, my drug, my device is a little bit better, okay? It's slightly incrementally improvable, there's established competitors, you're gonna go in there and bowl them over. For the most part, people don't invest in those very much anymore because it's hard. It's hard to do that, okay? Resegmented markets are interesting, right? Because now you're going into a market and you're looking at it from a different angle, right? Cancer is that way, right? Now targeted therapeutics, how you can go in and say, look, if you have this mutation, crizatinib, for example, which is an ALK3 inhibitor, you go in, you have an ALK mutation, treat that. That's a resegmented market. Sometimes it's difficult adoption because people don't want to do that. And then finally, there's the new market. Dyslexia was my example to you, right? There's no solutions. You don't have anything for it. It's going to be really hard. And most often, the problem with new markets is your buyers are like, my salesforce doesn't want to sell that. Particularly if it's like a GP sales force, one that has to go to a lot of people to sell, right? Dyslexia would be a problem. Why? Why would dyslexia be difficult to sell it to? Question. Enlighten me.
Not already mentioned.
Huh?
Not already mentioned why.
No. Why? Why is it difficult to sell into dyslexia? What's the problem with dyslexia about the market in general? Yeah.
Are there any large specialist centers for dyslexia?
That's it. There you go. It's hard because you have to go to all the psychiatrists. There's a ton of psychiatrists out there, right? Pediatric psychiatrists. How many would you go to? Who's treating the most dyslexic patients? You know, it's not a mass of people like glioblastoma, right? We just go to the great centers and do 15 sites, we're good. You can't do that, right? And that's what's hard about it. So the idea of selling into general practice is no longer interesting. So this is the final thing, and this is kind of funny. You were like, I got this, I understand what Imran's saying, he's telling me this is great. So I'm going to go into a great market, I'm going to find the market, and then I'm going to innovate in it. Never happens. This is what happens. I got this cool tech and I want to apply it to something else. All right? That's how the world works. You just hope your cool technology applies to something that's really interesting. Okay? And what dictates what your cool technology will do? And it's all the things that we've talked about before, right? The patient, the physician, and the payer. Okay? The other thing that's really, really important is your regulatory strategy. Okay? Because you're going to get approved for last line of whatever. You're never going to get approved for first line. Okay? For glioblastoma, for example, I'll give you my example. We're doing it recurrent. We're talking about patients who have 4 months to live. They're at the end of their life. So their immune systems suck, right? And we're just hoping that we can get a small percentage of the patients to go up so that we can move to first line. We get approved, we will only be in second line. Then we have to go do trials in first line. So I'm not going to go tell the world that I'm going first line. I have to say the market is this size based on this number, based on a small percent of the patients. And that's what you have to think. That your regulatory strategy is incredibly important on that, because you can't say, I did this in fourth line, I'm gonna get first line revenues. And that's all too often that happens. They don't realize how difficult it is to move up the categories, okay? And far too often, the patients you're getting are so sick, particularly drugs, if your drug was a first-line drug, it might have worked, but because they were so sick by the time you got there, it wasn't there. So it's a little bit of a yin and yang, because the FDA can't allow you to be in first line. They're not going to allow you to be in first line because they want to make you prove it with your safety and efficacy and last line. Okay, bottom-up models are really not fun to make. I'm going to make you guys do one. Basically, from a bottom-up model, you say, look, here's the total population. There are 29 million diabetics per year. That is not per year, the prevalence. In the United States, there's 29 million diabetics. Okay? Now, you have to figure out, by segmenting down from 29 million, how many can my drug impact? Okay? And then you have to think about what are all the issues around that. And not only you think about prevalence, which is what I just gave you that number, which is 29 million, think about incidence too. How many more patients per year are going to be there, right? Because the 29 million, they're currently on therapy. You know, what you're trying to figure out is where can I get either new patients or ones who are converting over to my therapy. All right, so there's a lot of issues to think about. And there'll be the top-down model is the easy one. So like, well, the established market is $3 million. I ain't going to take 2%. So I'm good. 600 million, 60. You know, it's really easy to do that. But the reason you do a top-down as opposed to bottoms-up is because it gives you a reality check on what the numbers are, right? If you take any more than 10% or 20% of the market at your peak, you should walk away and go back into your calculations, because it's very unlikely you're going to get more than that. Because you yourself can't make that happen. But other clinical trials and other things will get you there eventually, potentially. Okay? So you have to think about that further. So you guys are like, I don't know, it's 5 of this, and I've already gone over time, so it's fine. But I want you to think about, I want a number. You guys are going to separate into 5 groups. Sit around, you guys all have computers, which is awesome. And so you don't have to listen to me. And you can say 29 million patients, diabetic patients here. I want you to come up with a number of how many will be there for inhalable insulin. How many potential patients there could be. Now think about what we've talked about the continuum of patients, okay? And then where you go is the CDC website. It's the best website in the whole world, besides behind clinicaltrials.gov. Those 2 things make being a banker really, really freaking easy, because it tells you incidence, it tells you prevalence, and it tells you how big things will be. And the other thing I always tell you to do as entrepreneurs, if you're really interested in this, don't trust anyone. Trust yourself. Do the primary research. Don't go to somebody who said, oh, I heard the number was 29 million. You know, go find that number and then cite it. So that when an investor comes to you and says, where'd you get the number from? Oh, I got it from CDC. Or I went to a physician, he told me this. Or I went to that person, I did the primary research. I didn't pull it from something else. Because that's what people get in trouble.
We're going to break up into 6 groups, I think.
Whatever.
Yeah, 6 groups.
Okay, go on your websites, go to CDC, figure out, literally go to CDC, diabetics prevalence, CDC if you want. You can do whatever you want. And then I want you to come up with a number. Now, remember what I told you about incidence and prevalence. I told you about what the continuum looks like. It should take about 10 minutes to figure it out. Okay? And come up with a number. And I want to know what the number is that you've come up with and what assumptions you went into.